are you? And we did last week, Tuesday's webinar, which is related to do-it-yourself 1040, right? Remember we talked about how these 1040, the areas that was needing to know and also got updated. And in today's 30 minutes, I want to knock off every differences between your 2020 tax return versus your 2021. A lot of people, okay, in our tax world, I always tell people that if you're a tax person, in the way you are a historian, because you know the past, you know what 2020 is. So you're just working with past information, right? 2021 is already gone. Now the tax people are just start working on 2021. So always like a little bit behind. So we are historians. But what about your financial planner? And they are these people, blue sky creamery kind of people. They are just like projecting the future, most of the time very unrealistically, but that's their job. Their job is to dream for the future. And your tax preparer's job is to land you on the ground with the history. But the difference between me, Community CPA, and our firm, we are kind of the people with both. We look at historian data and from the historian, then we also have a really good understanding of the future. So last Tuesday, I covered you with, you know, what's happening right now and the 2022, what might be different, you know. Of course, it's not all finalized, but what I did was like, you know, the most we know. But today I'm going to give you the history piece. So what happened in 2020 and what will be in 2021. So let's get going. We knock it off, okay? And let's share my screen. There is no responsibility disclaimer. If you really want to get something really clear and come to talk to us, retain us as your service provider and that we can work for you and making sure that you are doing it right. But getting through internet, doing research, you know, a lot of people is really good with that, but that doesn't mean that's the reliable knowledge source. All right, couple of people I saw, and this is the first time you come to my webinar, and welcome to Community CPA's webinar. And look, I have to brag about myself a little bit, and I do have a book on Amazon and you can get, and I also serve on this IRS panel called the National Taxpayer Advocacy Panel. So basically, we are fighting for taxpayers' right. If there's anything can be improved by IRS, and then we are the body giving the recommendation to IRS. So you have me, now you know me. I am one of those members on that panel. So you can contact me for that. All right, the first one, child tax credit. In 2020, that child tax credit was from 0 to 16 years old. Okay, if you're 17, if your kid turned 17 in that year in 2020, and it doesn't get it. Okay, so that's a $2,000 per kid. But in 2021, which is the tax return we're doing right now, that is from 6 to 17. See, 1 year more, one more year, okay, for child tax credit. And 6 to 17, 3,000, younger, 3,600. All right. So of course, and if you make too much money, you don't qualify for that. The threshold to qualify for full credit, the AGI for single married files separately need to be less than 75K. And for AGI for married need to be less than 150K, right? So that is where the child tax credit. All right, next. This is the dependent care tax credit. Dependent care just means the daycare fees or the babysitter that you hired to take care of your kids. In 2020, that was up to 3,000, right? If you have more than one kid, it's up to 6,000. See, that is being changed in 2021. So you can have a lot more. And, you know, the spirit is very simple because over the pandemic, you remember how difficult that is to, you know, to you to go to work because your kids would have no daycare to go. So they give you more credit to compensate you for paying more money to childcare providers in order the kids to go to daycare, in order you to go to work. See how the government was putting in thoughts in taxes. So I always say that tax is actually very interesting. You know, before I got into doing taxes, you know, I always considered myself as very neutral. I don't want to get involved with politics, and I'm too scared of, you know, being chastised by the other side of the party, and it's just self-conscious. I don't want to get involved with politics. But did you realize that if you're really a good tax person, you are naturally, automatically, unconsciously becoming a politician? Because you actually look at what the president is doing and start to expressing opinion without you even realize that. So I always see how taxes is being used as a tool for good things, for bad things, for things I agree, for things I don't agree, right? So that is a very good example for them, for the government to put in some sort of tax incentive to stimulate economy in certain ways, right? So one of the biggest tax credit that is coming through in 2022 is the first-time home buyer credit, right? President Obama has it, but President Biden literally doubled it, and it is $15,000 tax credit. So if you are the one wanting to buy houses, but just never really made up your mind, not sure what to do, hey, it is time, because right now you have this first-time home buyer credit is $15,000. That's a tax credit, folks. It's not an income deduction. So that means $15,000 is like you made $100,000 income that is not paying taxes. So that is how much of credit is giving. So good deal, right? That is the way for politicians to stimulate economy. So that way there's more people buying home, there's more money exchange hand. So the realtors are busy working, and you know, people are borrowing money. So all of that will contribute to the economy up and downs. And so this is just what politicians do, the presidents do, and changing taxes is just their must drink cup of tea and when they become a president. That's why everybody who is new president, and they use tax as tool to fulfill their agenda. Now, next one, earned income tax credit. And this is a credit. This is a President Biden's change. And now in 2020, the earned income tax credit, you must be older than 25 and younger than 64. Okay. And then now that is changed. So you must be greater than 19, and the age got extended. If you work, and you got earned income tax credit. So income tax credit has expanded for older people. All right. So this is the biggest change in 2021. And you see, that is the 19 years old is also got lowered to 19 instead of 25. So if you are single mom and 19 years old, and you actually would qualify for earned income tax credit. And I do believe that there is a special clause for even 18 years old. So you have to specially qualify for that, but it is also possible. So earned income tax credit, that's a big deal, right? All right, unemployment compensation. This is very different. In 2020, if you recall, and there is a portion of unemployment benefit, you don't pay taxes, right, folks? And it doesn't exist anymore for 2021, and it's all taxable. So if you continue getting unemployment compensation in 2021 and referencing your low tax in 2020, then you're not thinking it right, because it's no longer have that non-taxable portion. Required minimum distribution. This is also a big change. It's more for older people. The required minimum distribution are for the older people who draw pensions. You know, sometimes when you're older than 72 years old and they say that, well, you must draw your pension, you cannot leave all the pension in the account, accumulating interest, making money and leaving it for your child. And even though they're 50 years old already, but they're still counting on your pension to pay for their living. So the government discouraged that. The government says that you need to do minimum distribution. So that minimum distribution need to come out, so you need to pay taxes for. And in 2020, and the President Trump said that, well, you don't have to do that. You don't have to get a minimum distribution, no penalty. You can keep it in your plan. Okay. And President Biden came around, and now it is required. You have to withdraw. You cannot, just like before. So 2021 changed back. All right. And the standard deduction. The standard deduction in 2020 for married couple, remember, was $24,800 for married couple. And if you're older, you add some more, right? And the 2021 reflected on inflation. Not enough, not enough. Inflation was much greater than that. And you know, if you're older, you plus $1,350, only $50 inflation. Give me a break. I went to shop for buying the same item, and I came out, and it used to be $100 bill for the grocery shopping, and then now it can be $190. It's so much more expensive. So, you know, I have my son went to this local grocery store to buy a whole chicken. You know, he never do shopping, so he just went there. I said to him that, hey, you know, Andy, go buy that whole chicken for me, and Mom gonna cook that for you. And he was calling me from the grocery store, goes, Mom, and I don't know, I'm getting the right chicken because it is $16.99. I thought you said something about $5.99. Am I getting golden chicken, or what am I getting? So I said, well, that's inflation, okay? That's just what they are selling right now. It used to be $6.99, $5.99. Now it is $16. And you know, just get that. It's the same chicken, but price went up. So, you know, for this boy, and never really do much of a shopping, and it can just calling me, goes, is that right? You buy chicken for $16.99? That's inflation, okay? We have a lot more than what they give us on the taxes, but take what they give you. What can you do? You can't change the number, right? So knowing that the standard deduction should reflect the inflation in the country, so that we don't actually lower our living standards, but actually is not enough. And then of course, for single, you got in 2020, it was $12,400 standard deduction. Now it's $12,550. So same with head of household, got increased by a little bit. And the folks, consider maybe standard deduction is not for you, and doing itemized deduction. I know it is hard to do itemized deduction because they limited our state taxes to 10,000, right? The state taxes, income tax and property tax, all of those taxes together, they only allow 10,000. And the people who lives in the state where the state charges income tax, we lose big time. Of course, people in Florida, they are fine. They don't pay income tax, so their property tax is also not as expensive as Midwest. So they probably just fine. 10,000 would cover them. But people who lives in Midwest, we probably spend 30, 40,000 on taxes. From income tax to property tax, we're only allowed 10. So that's why you couldn't get over with this standard deduction. You might just be a standard deduction person, right? So that's where, you know, sometimes you probably wonder, why is my standard deduction, why is my itemized deduction is so low? But if you look closer, you will know why, because they changed the rule. President Trump changed it, okay? Don't blame everything on President Biden. All right, so long-term capital gain. So this one, I talked a lot about long-term capital gain because this is a big advantage for a lot of people. If you do investment as a long-term, know that you have a 0%, 15%, and 20%. See, 15% and then 20%, because that's the highest rate, 20%. Do you know that income tax rate, the highest is what? 37. So it's 17%. saving. Let's say if I make a lot of money, and let's say my AGI is 500,000. I made $100,000 long-term capital gain on top of the 500,000. And if it is long-term, the maximum rate I pay for that 100,000 is 20,000. But let's say if I did mark-to-market election, or I was treating it as my day trading income, then that 100,000 gonna be paid $37,000 taxes. So that's the difference, okay, folks? And also the other thing I want to mention to you, when you have a capital gain, sometimes the capital gain is coming from your capital, coming from your selling of your business. So let's say someone step into your business and goes, I want to buy this business and I'll give you this much money, and you walk away. And sure, you made money. It's a long term because you had your business more than 1 year. But keep in mind that if you ever get into a situation, people are buying your business, even if you have a lost business, your business didn't make money, but someone coming in and said to you that even though you are losing money in business, but I like your business, so I'm going to give you $20,000 to have you, to buy your business. So that 20,000 still representing your gain, your capital gain. So in that case, I really want you to know that there's a lot of things around that area would make you pay no taxes. I am serious, no taxes. But you just need to know all of these sections, like section 1202 and the state exemption, all of these little things that you don't really know. And please know that you might have an opportunity to not paying taxes at all for selling your business that is more than 5 years old and that is a small business. Just keep that in mind, okay? I know it's not related to the 1040, but I want to throw it out there just in case you have a situation like that happens. Student loan, allowing workers to exclude up to $5,250 of college loans paid by their employer in 2020 from taxable wages. That was the treatment for 2020. And then now, and allowing you exclude up the same for college loan paid by employer in 2021. And starting in 2021, most canceled student loan debt that incurred is not taxable. Did you see that? Did you see that? So your student loan benefit went up. So that's student loan, folks, right? Let's look at another one, charitable donation. Charitable donation, if you claim standard deduction, and you can claim that 300 outside of the Schedule A, okay? And in 2021, that went up to 600 for a married couple. So make sure that let's say you are your churchgoer and you file standard deduction. So your donation, your donation to the church and doesn't really get counted because it's you use standard. Bring that out, okay? Bring that out of Schedule A, deduct it upfront on the first page. All right, so just make a note on the charitable donation. And adoption of child, hey, you got $140 more. Are you gonna adopt more children? Of course, nobody adopt children for the adoption credit. And everyone I know who adopted a child is because they have the heart. The adoption credit, just make sure you don't forget it. That's all. And I know you are not going for that. Who is going to care about the adoption credit while you have your life, you have your child life forever, right? So that responsibility comparing to a $14,440 credit is nothing. But if you did, don't forget to claim that. Why not, right? Get yourself that, and if this is the case. All right. Estate gift tax, and the limit went up. Is again, they're talking about inflation. So, I should say went down. So it did went down. Actually, if you remember when President Obama was the president, he lowered this to 3 million, if you remember. And so Trump came on board and it got that increased. Obviously, this is for wealthy people, right? And the people who are listening to my webinar right now, I bet you that we all know and who is going to have 11 some million dollars in estate. Estate just means that someone's net worth. So with what they have minus what they owe, they have that money. So this is quite a bit money, and it's definitely not a majority of American. This is 1% of American, and it would have this kind of estate, and so they got it for free. And you know, when a Democratic Party come on board and tend to lower that, but when the Republican president come on board, tend to make it bigger. So it's a balance, right? So I actually don't wish any party to be on board forever, because that would lead the country into something different. But it is good to have that balance, and you can see a little effort in here, so little. So President Biden didn't really chop it off by too much, right? Maybe he's still gonna do that in 2022, we'll see. All right, now let's look at standard mileage rate. This is a worthwhile to keep track, okay? I always tell folks that if you really do end up doing mileage calculation, and I'll tell you a story. We just had we just had a client and gone through the IRS audit on mileage. He's a real estate agent, and he actually have this really comprehensive printout from the listing where he showed the houses and all that. So he has all these mileage, and you know, from my standpoint, it's a pretty good mileage log. It has the date, the purpose where they go, and also have the address, and anything you needed is all on there. So the auditor and wanted to see odometer reading. So like he claimed about 32,000 in the year for driving. So the auditor want to see odometer reading from beginning of the year to the end of the year has more than 32,000 miles on it. And not realizing that this gentleman don't go to do oil change with outside people and only do it himself, so he never had it. And without that proof, and the mileage deduction would not work. Okay, so folks, and I only say this, so if you're in business, I don't understand why you are not purchasing your car under your business, and to have the car be the business assets instead of trying to give yourself a nightmare to live on and doing mileage deduction. It doesn't work, and it has so much requirement. And you need to take a odometer reading today. If you don't change oil with third party and you can get a receipt from them, then you take a picture of today's odometer reading and with your calendar on it and with a timestamp. Then at the end of the year, take another one, save that just in case you get audited, because you do have to come up with $32,000 driving record in the car in order to sustain that you really did drive, right? What if you walked over to that client? How can you prove you didn't walk, right? So that would be, I don't think is unreasonable request. I thought it was a smart request. So we need to get smart, knowing what the government need to see in order you to get deducted for the mileage. So now this is for the medical, all right? And then for the standard mileage, and this is the same, did not change. So these are the things that we have on the related to 2021 filing, folks, and make sure and you actually take a look at today's webinar and it really knows those change. And on the mileage side, that is changed. So someone was giving me a note saying that, what if I have a Tesla? So do I still use the mileage? Oh yeah, you still use the mileage, because they didn't come up with something new for the electronic car yet. So for right now, if you have a Tesla, you're doing the same mileage deduction. Okay, and thank you for joining me. And on Saturday, folks, listen up. On Saturday, I will talk about ERC credit. If you don't know what ERC credit, that's employee retention credit. And if you don't know how that applies to you, you have to be an employer has payroll. If you have a W-2 out of your business, you might qualify for that. So listen up on Saturday. I will update ERC, and it's a very exciting credit money to get from IRS, and they are set there for you. If you don't claim, it's your loss, and I will talk about that on Saturday. I'll see you on Saturday. Okay, bye.